can see some study material also. If they have shared with you like fixed income books or something,
Yes,
you can go with
they
that
have.
book also. And but like whatever PPT and whatever I have covered now, please go through it again and again. In the revision section also, when we'll be revising the entire course, I will tell you again, whatever we are revising, just go through that at least. But minimum that should you
Right,
focused on. And in advance, if you can learn more, then that is a bonus for the course also and for your life also.
right.
Okay, I think more, not more than that. Atul, just one request. If you guys have WhatsApp group, can you just share a WhatsApp message like class had started? Otherwise, I'll start in 2 minutes.
Okay, I will ask somebody. Yeah.
Just tell them that this is like today we are trying to conclude the course. So just tell them to join.
Yeah, we have shared it on the WhatsApp.
Sorry, is my screen visible now?
Yes, it is visible.
So Atul, meanwhile, you just say hi on my the email ID or any of you, because today Bhavna I think is not here. So generally I share my material with her only. So I will share that study material with you, and you can share it with everyone.
Okay, so I don't have your email ID. If you can send it, sir. I mean, or
Just write MOHIT Mohit.
okay, 1 second, sir. Sorry. Yeah. Yeah. Tell me.
Mohit MOHIT Mohit
Yeah.
dot Kumar dot KUMAR Kumar
Yes.
dot OFFCL
Mm-hmm.
at the rate gmail.com.
Gmail.com. So this is
Yes,
OFFCL. It's a
yes,
short
yes,
form of official, right?
yes, yes, yes,
OFFCL. Okay.
yes, yes, yes. Okay.
Okay. Sure. I'll ping you,
And
sir.
yeah, I was on mute. So did you listen that I was telling I will try to share this newspaper thing and all today?
No, we didn't hear that.
Oh, sorry. I was continuously talking. So I was saying this class is mostly today is about theory and all. So I did not want it to be bit boring. So what did I do? I tried to downloaded some newspaper articles. So what I was thinking, like I will align this theory along with some practical things, what is happening in the market and all. Because there is no use if I keep repeating what is written in the book. You guys can do Google and read that easily. That you guys can also do. So from my side, I try to, what did I do? Whatever concept we will learn, I try to make it little bit more aligned with the practical examples, what is happening, what are the cases are happening. So, and there are some video also I will try to show so that it would be bit fun. And what will I do? I will share those newspaper articles and all with you. So today it would be like we will discuss something and then you guys read that article or whatever. So you will have little bit more fun instead of just listening about theory and theory and theory. So I will share it with you, Atul, and then you can share with the class. So it would be like in segment. First we will discuss little bit, then I will share one cases. I also generated hypothetical examples also, and those also you can read. So that in that way we will try to finish this class. So it won't be that boring also. So let me repeat what did we do in the do in the last class. We were discussing about this default risk and all, where I discussed about what is happening in India across the world when it comes to interest rate risk and all. What are the consequences of default, and then how to measure this default risk and all. Where we discuss certain methods through which we can actually identify or indicate that the company is going towards this credit risk default or not. And then we discuss certain terminology associated with this default thing and all, where probability of default, distance to default, credit score, all these things we discussed in the last class. Then we took one example and how one by one we can see multiple factors and ultimately can come to a conclusion how to tell whether the company is having default probability or not. And then what happens, so here I concluded in the last class. So today we will discuss final version of it, which is probability of default. But before that, I would like to share certain news which is happening. Like majority of these cases you guys might have heard. The most important was the Evergrande crisis, which happened in China around 2021. I think this we discussed in the last class, not last, but I think in the beginning of the class also, when we were discussing about Russia default and all. Then you might have heard also Hercules Offshore. This is also an oil and gas drilling contractor. So they also filed for bankruptcy due to a steep decline in oil prices. There are multiple other cases also across the world, like Whiting Petroleum Corporation 2020. They, due to COVID-19 and all, they also filed for bankruptcy and all. Then we had Nyman and Marcus. They also, like, it was in recently given the multiple factors, including the pandemic and a significant shift in the consumer preferences and all. They also filed for the bankruptcy. These are the cases actually you can see in the Google also and just read about it. There are some interesting cases which actually indicate that's how risky this bond market. Though we say, okay, It's a fixed investment securities. We will get fixed income and all, but they are not free from default. So default happens, and these companies are the perfect example because these are not very small companies. They are the big ventures which ultimately went into default. Then in India, what is happening? India also in recently we there is a surge in the willful default cases where many companies or firms actually decided to go for willful defaults. What do? They actually they have capacity to pay the debt back, but they generally pick other ways because through which either they can use this loan amount for their personal use or something, and there's some protection also they get because they don't care what is happening, their pockets are ultimately full and all. It happens with individual also, it happened with individual, with business firms also. So even in now you just see the figure here. Anyone is saying something? No. Okay. So in India, public sector banks also like they are struggling with this issue where there are people who are, if you read this Business Standard newspaper also, there are 2 to 3 pages are always filled with the news. Okay, this particular person, they gave new information in the news ki this person has been defaulted on those particular amount and all. So there are like top 50 will fall defaulters alone have a amount of like 87,295 crore. You just imagine what will happen to our economy. This is not a small amount, but the people are going with this kind of malpractice and all. Then this is actually increasing in India a lot. And RBI, SEBI, bankers, insurance authority, everyone is actually concerned and try to take certain measures where they can avoid this. Then we have very famous case ILNFS. Actually, what is happening? They also filed for the default, and this is actually huge setback. It was like I think in the infrastructure leasing and financial services this company was, and the total amount was huge actually. And this actually uh, not only affected the investors who was more interested in the ILF and FS. Actually, there was a spillover to other financial companies also, and there was a lot of trust issue and all. This company is still going on. The issue is still going on. Today, the first case we will discuss about ILNFS. I will share that newspaper article with you guys. You just read what happened actually with ILNFS. Same thing, very familiar, very no, very well known case is Vijay Mallya's loan default case also. This is also like EDC is around 1.6 million euros in France also. So now they are trying to bring him back to country also, and some issues are also going on. He has been considered as fugitive businessman. Okay. Then we have this credit card defaults. Now a lot of defaults are happening. I think that day we were discussing about this card defaults also, but some of you or many of you said we are not using credit cards. So I just close that conversation there actually. But now whoever is like in job or something, I'm pretty sure many of you are must be getting call, or at least if you are trying to order through Zomato or Swiggy or whatever, everywhere you will get a advertisement regarding get this credit card, lifetime free credit card. But what happens? Sometimes we spend more than what we have in our pocket, and ultimately you are not able to pay on credit card bills and all. So suppose your income is 50,000, your bill is 45,000, but you have other commitment also and you may not be able to pay on time, then you have to pay again interest. They charge up to 36 to 38% interest on time, and that amount is huge. So sometimes you're not able to pay, that also contribute to this credit card defaults and all. Then, okay, last concept of this unit was we were about to discuss is probability of default. What is probability of default? Like till now we were discussing how to measure this and all, this default probability, company goes for default, credit rating goes down and all. But what happens like, but companies are not only dependent the event when it will happen, they also want to take some precautionary measures also. For that, this is the better tool where they try to measure the likelihood of a company or of a firm or of an individual. They try to get the likelihood or probability that when this person may or this firm may get default based on certain factors. They collect multiple factors, their credit ratings, their income level, their the company's behavior, the management, and so on. Based on, they try to apply some very highly mathematical models and on, and try to conclude or bring comes up with the numbers that what is the probability of this company getting default on a particular amount and all. So for this, that disclaimer is if you want to do it in a more detailed way, that you need to have little bit understanding of basic econometrics, where this we discuss about is regression model and all. So what will I try? What will I do? I know many of you may not know that much econometrics in advance and all, because they talk about logit model, logistic model, then linear model, non-linear model, parametric model, non-parametric model, and all. So what will I try to do? I will try to bring it in such a way that you can have at least understanding. So what I'm assuming here, two things. First of all, you have little bit understanding of basic statistics or econometrics. If it is not there, I'll try to make it more simple and more in plain English so that you can understand. Second thing, one more portion next unit we will cover about there would be a little bit overlap with the security analysis and portfolio management. So that's why I will not discuss that much into detail. So that would be kind of revision for you guys. But here let's discuss what happens with probability of default and how do you approach, what is the common approach to calculate this default probability. So the first step is definitely you have to collect historical data. You have to collect historical data for this on different borrowers and all, and this data will have certain characters or certain factors. You have to calculate historical data on like factors like what is the amount, what is the interest rate, for how long that loan has been taken and all. Then it comes to borrower characteristics. You want to measure their credit score, their debt to income ratio, their employment history and all. Then it comes to default indicator. It could be a binary number, whether the person will default or not. If he will default, it would be 1. If he will not default, it would be 0. This number, what do? You try to split the data into two parts. We call it training set and testing set, where training set you use generally to build the model. On a small number of data set, you try to build your model. Once that model is ready, you actually implement that model for the actual data set or the larger data set where you try to test this data. Okay, or where you try to test this model whether it is able to uh, predict the default probability. Or you have already built the model based on training set, and now it is time to bring it into more practical like use it in a more practical manner to understand the default probability. So this is the step number 2. First step is the gathering the data on multiple factors. Second is splitting the data to build the model and testing that model on the actual data set. Third step is when you are building the model, this you talk about logistic regression. So I'll just tell you in simple way, logistic regression, when we talk about logistic regression, it is nothing, but you must have heard dependent variable and independent variable. So what happens in regression? What is the meaning of regression? Regression tries to understand or help you in understanding what is the relationship between dependent variable and independent variable. Dependent variable, like you want to understand what happens to a dependent. So for example, you have ice cream one side, and you have sugar level another side. So you want to understand what is the contribution of ice cream in increasing your sugar level. So sugar level is your dependent factor, which is dependent on the independent factor, which is ice cream. So regression analysis try to understand the relationship between two variables, in which one is dependent variable, another one is independent variable. So a given a change in independent variable, what will happen to dependent variable? That is the main purpose of running a regression analysis. Now, what is logistic regression analysis? So dependent variable side, generally all the values are continuous. Okay. But what happens sometimes, dependent variable may be binary. It could be 0 or it could be 1. So in that condition, applying linear regression will become little bit difficult. So we take the shelter of logit model, logistic regression, in which what do? They try to divide the dependent variable or the happening probability with the non-happening probability. So in that case, when you divide, like suppose 10% divided by 1 minus 10% with 90%, you can have a continuous value also. So logistic regression, just remember simple thing, nothing you have to learn all these things. Logistic regression we generally applies when dependent variable is in the binary form, either 0 or 1. If the dependent variable is not in the 0 and 1 form, you can happily go with linear regression, where dependent variable you will try to run a model and try to understand what will happen to that variable if we give certain change or shock or whatever to the independent variables. So logistic regression is very important when it comes to measuring the default probability, and that's where we use this model. What happens in this model? See the step number 3. We use statistical software or coding libraries to build a logistic regression model. This model identifies the relationship between the loan and borrower characteristics. Okay, loan is the dependent factors, borrower characteristics are the independent factors, and the default outcome. Sorry, loan and borrower characteristics are the independent variables, and the default outcome, whether it is default yes or no, 1 or 0, are our dependent variables. Then what do we do? This model actually helps in identifying the in assigning the coefficients or weights to each independent variable. We will discuss one example also through which you will understand it better. What does this coefficient do or this weight do? It tells you that given a 1% change or given a 1% increase in the consumption of ice cream, what will happen to your sugar level? So this is the meaning of this measuring the impact of coefficient on the dependent variable. That coefficient actually tells you the strength of that relationship. Okay. So what will happen if, so suppose what is the relationship between COVID-19 pandemic certificate, sorry, vaccine on this particular disease and all, which report came and all. So try to measure this kind of information. What will happen to the income, or what will happen to the consumption given the increase in the income? That is the most common in classical model when we discuss about regression model and all. So that's how this model also will try to understand what will happen to the default probability given a change in the independent variables. Okay. So the third step comes model coefficient. This model coefficient, as I already discussed, the logistic regression will generate this coefficient, which will present the impact of each variable on the log odds of default. What is log odds of defaults? The dependent variable. So logit model, we call it log odds of default, meaning the probability of default. Then we will calculate the probability. So for probability, there is a formula they have given, which is PD divided by 1 divided by 1 plus e power by inverse of g. So you can read these. What are these factors? PD is definitely the probability of default between 0 and 1. If it is default, no default, it is 0. If there is a default, it is 1. Okay. E is the base of natural logarithm, which actually generally the value is 2.1718. And Z is the linear combination of the independent variables and their coefficient calculated using the formula. This is the formula for calculating Z. So what will Z do? Z will try to calculate those coefficient, which coefficient you can directly put in the probability of default model and calculate the default probability. So just don't get panic. We will discuss one example step by step. You can repeat the example by yourself and things will become very easier for you. Okay. Then beta note is the intercept coefficient from the logistic regression model. Beta note actually tells that given all the variables are 0, if all the value of all the coefficients are 0, what would be the minimum impact? So there should be some minimum impact on the dependent variable, even everything is 0. So it is saying like, given that ice cream effect is 0, given that sugar, given that there is no impact of ice cream, but still there would be some change in your sugar level. It could be because of other factors also, given that you are not eating ice cream at all. But ice cream is not the only factor which is affecting your sugar level, right? So given that ice cream effect is 0, what would be the minimum impact on your sugar level? That beta note measures. Given all the things are 0, what will be the minimum impact on the default probability? And then beta 1 comes. Beta 1 comes and it tells the strength of that independent variable, how this independent variable or how much this independent variable will affect the coefficient, will affect the dependent variable. Beta, if it is beta 2, how the factor 2, how much the factor 2 will affect the dependent variable. Beta 3, how the factor number 3 will affect the dependent variable. And that's how you try to measure the strength of each and every variable and how it is affecting your dependent variable, which is default probability. Okay. Once you have run this model, we have to calculate the probability of default finally for the new borrower. What will you do? You have new borrower's loan and borrower characteristics already in the formula for Z. When you will calculate the Z value, you can calculate the coefficient for beta 1. And once you have calculated all this value, just put this value into this formula and your value will come. So suppose let's take the example. This is the data given where loan amount is this much, 20,000, 15,000, 25,000. Interest rate factor they have given, credit score they have given, debt to income ratio they have given, default either yes or no they have given. So what this is trying to tell you, you are calculating a default probability for which they have given multiple factors. What will you do now? Coming with those step by step. First, you will build the formula. So hypothetically, imagine that you have built a logistic regression using Stata or eViews and all, given the historical data. So historical data of what? Historical data of interest rate, historical data of credit score, historical data of debt to income ratio. You had historical data on all these factors and you plug those value in that Z model and you have calculated the coefficient. Sorry, you use this value into logistic regression and you have calculated the logistic regression. So in the logit model, your dependent variable would be yes or no. On that other side, you will put all the variables, the coefficient for credit score, the interest rate, debt to income ratio. You will run a regression analysis and suppose you get these values. Intercept is this, loan amount coefficient is this is this is this. If time permits, in the end, I will tell you a practical example also how do we conduct regression analysis and all in Stata and all. So right now I'm just trying to tell you, just giving you the basic understanding. So suppose this coefficient values you have calculated one side. Keep all these things in one notebook. Your second step would be now you have already this model based on historical dates of all these factors. You have already some values in your pocket. Whenever it's like you have certain data, whenever you will get new information, you will use this data and will try to calculate the default probability. So this is like your treasure. You have already done all this calculation. Whenever someone new person will come to you, what will you do? You will bring your data or your insights, whatever you've done about the market, will fit this borrowers into that model and try to calculate his default probability. So you have your treasure and all these factors you have kept in your account or somewhere in the book. Now what happens? One of your friend comes to you and this he apply for the new loan. Okay, so suppose he wants a $30,000 loan with an interest rate of 4%. His credit score data you have 750. The debt to income ratio is 0.45. Okay, you have data, you have historical data also. Now you have data for the new loan applicant also. Now how will you calculate default probability? First you will calculate the Z value. You have already given these factors beta 1, beta 2, beta 3, beta 4. Z value also will tell you this only. So in Z value beta naught is already given minus 2.5. Beta 1 they have given. X1 is always the amount. X1 is factor 1, your loan amount. Then you have beta 2 value 0.20 here, beta 2 value is 0.20 here, and your factor number 2 suppose is this interest rate. Then you have coefficient for third factor. Your third factor is credit score. Then you have factor number 4 coefficient and your factor is 0.45. Like this, you have calculated the Z value. Once you have calculated the Z value, you don't have to do anything. You just put this Z value into the probability model and you will calculate the default probability. So the default probability is 90.7%. Please do not give any loan to this person. Okay. So his default probability is like if you will give him loan, there are 90.7% chance that he will not pay you back or he may get default on this loan. So the process was looking a bit difficult for you guys. I totally understand because when you talk about theory, it may be difficult. But if you have seen the example, it becomes more easier. You just have to calculate the Z value and the Z value you have to put in the model and that's how you will calculate your default probability. Okay, so that's how we calculate the probability of default. This is the simplest version of probability of default. After that, you have so many advanced models also how to calculate hazard rate, loss given default and all. But that is like for more advanced and like it comes under financial risk and management course or something. But that much advance is not required right now. You need to understand the basic. once this basic calculation is done, you can easily interpret or implement those advanced models, and you can easily understand how to calculate the default probability. For example, here I have given you already calculated value for coefficient. But what if no coefficient is given? Then you have to calculate coefficient by yourself. Okay, you have to calculate in the strata or whatever value you will take. You have to calculate this coefficient by yourself. Once you have coefficient, you just have to calculate the z value. Once you have z value, you have to put this z value into probability of default model, and that's how you will calculate what is the probability that a person will go default on a given loan. Okay, so with this, actually, I'm providing the summary of this unit, not unit, but actually about this default and thing and all. This simple model is also over. Now, what is the summary? So first, what did we do? First, you need to identify the bond risk. It could be interest rate risk, it could be credit risk, it could be call risk, it could be liquidity risk. Okay, once you have identified the different risk factors based on interest rate, based on credit risk, and whatever, then you quantify bond portfolio risk. Okay, that we already discussed how to calculate price volatility, how to calculate the duration. Once you have calculated price volatility and duration, you can also calculate the same thing for your portfolio and your overall risk. In when it's come to overall risk, we discussed about all this risk today. Not today, in the last class also, purchasing power risk, interest risk, default probability, and so on. Okay, so but what happens actually? So the ultimate question comes, what happens? How can you prevent it? It's not part of this unit, but every time this question comes into mind, what will happen if this people go on default and all? What precautions you have, or what precautions people take? It happened during 2008 financial crisis also, when company or the big banks like Lehman Brothers and all went on default. But there were some smart people who actually took certain measures, like how can they control that risk, or how can they buy insurance against those risks. The one of the important factor, one of the important tool came into picture at that time was credit default swap. It's a kind of like insurance premium where you buy from a third party. If party A gets on default on a particular loan, what will happen? The third party, generally is a major bank or financial institution, will give you a guarantee that you pay us little bit premium. In return of that premium, we will give you this credit default swap, which in the case of default condition will recover you from that loan, or we will pay you that loan. So this is actually part of your unit 5, which Vanessa ma'am has already covered when we were discussing about this complex debt obligations or structured products and all. So, but I'm just covering little bit because this is very important thing, and this credit default swap became very famous. And during 2008 financial crisis, it played a huge role. So in simple term, like you can understand like this. Suppose you are a buyer and you are worried that your friend may not pay you back. Then what will you do? You buy a CDS from another person. Like you can buy from me, or you can buy from a bank in exchange for a small fee. Like I will charge a small fees from you, and I will say, okay, giving you this CDS to protect your money. What will happen? If this person like me or like bank or another investors, it will agree to pay you back if your friend defaults. Okay, he doesn't pay the loan. So suppose you have a CDS to protect your 1,000 rupees bonds you own from a company called Risky Corporation. You pay a small fees like 10 rupees per year to CDS seller like bank or like any another person. If Risky Corporation goes on bankrupt and can't repay its bond, the bank will have to pay you back the 1,000 rupees, $1,000. And there's a very famous movie actually on this series, how he protected his. I think I don't know how many of you might have watched this movie. So, am I audible first of all? Like I'm continuously talking. There's no ha from your side. Am I
Yes,
audible?
sir. Yes, sir.
Ah, okay, okay. So there's a very famous movie also. You guys get some time and try to watch this movie. I'm just playing a small clip of that movie here. How smart that guy is, and how he protected his a huge amount during 2008 financial crisis. Shall I go ahead? Just yes or no?
Yes, sir.
Okay, I'll try to see in the. I don't know how many of you have this big short movie you might have watched. So I'll see. I'll try. So I think voice may not, you guys might not be getting voice that much, right? It's a bit low. So you just try to see the subtitle also, that how smartly that guys protects its investment. Just watch. First of all, tell me, is it visible?
Yes, sir.
Hmm. Just watch for 2 to 3 minutes.
ऑडियो भी शेयर करना पड़ेगा सर.
Huh?
ऑडियो भी शेयर करना पड़ता है.
I don't know how to share this audio, but let me see. From team only I have to share?
मे बी आई डोंट नो बट इतना पता है करना पड़ता है.
Okay, तो आप अभी फिलहाल subtitle से देख लो please. बस just an interesting clip. Otherwise, I'll
ओके
share that link with you. You guys watch this. Okay?
ओके.
Just 2 minutes you guys can watch. I'm not going to play it for 4 minutes. Just watch it for 2 minutes. Where did it go? Here. See the bank name in backside. Very famous bank. Okay, let me just summarize it because its no voice is not that clear. Just try to watch this. This is a short clip there. So what was happening here? That guy was taking guarantee. Like so during 2008, I think, as far as I know or whatever I read, these people were selling it like a very good product and all. They were not discussing, they were not thinking that this is building up a bubble and you are selling this mortgage, CDS and all to the people. And the values actually was going down in general. So this guy wanted to protect, he knew that that bonds also may get default. So he wanted a protection against it, and that's why he went for the credit default swap that time. So you watch this video, it will make your understanding more clear that how credit default swaps can help you to protect your money in the case of default. Okay, what will happen now? Finally, we will read Indian case also about IL and FS default case, what happened, how it happened and all. So I'm sharing with you that case study actually right now. It's a 6 to 7 minutes reading. No question I'm going to ask from that. Just read it. It is just for your understanding. And then with that case study, we will conclude this unit. Okay, so just give me 1 second. Uh, Atul and Bhavna, I'm going to share with you guys this case study. Any of you can please share it with the rest
Yes.
of the. Okay, okay, fine.
This is unit 3, sir, right?
Yes, unit
In
3,
the
sorry.
and unit 4 also we will be covering today.
Yeah, unit 4 we will try to cover as much as possible. It's like half an
Sure.
hour class left. We can cover it quickly tomorrow or whenever you
Okay.
guys are willing to do, or
Sure.
else I will share my slides with you. That would be more than enough because that is mostly theory actually, unit 4.
Okay.
Okay, so I'm sharing this Island FS is a business standard newspaper article. So please share it with everyone. It's a 5 to 6 minutes reading. I have shared with you right now immediately. You both might have got it, and Atul, just confirm, or Bhavna, if you have got it, the mail.
Not yet.
Not
Atul,
yet.
you?
Yeah. No, not yet.
Okay. Message sent, it is showing. Okay.
Got it.
Okay. So it's a 6 minute case is like article, 6 to 7 minutes mostly. So 8:18 we will continue this from unit 4. Okay. Just read it for 6 to 7 minutes. I'm going to catch some water. You guys just read it. Okay. Thank you. All right, I think you guys might have finished this reading, right?
सर इन्होंने शेयर नहीं करा, लेकिन मैंने खुद से गूगल पे से निकाल के पढ़ ली।
अरे भैया शेयर कर दो यार, कर दिया करो। Bhavna and Atul, yaar, you could have shared like the WhatsApp, at least you guys can share.
मैंने करा है शेयर।
Okay, कोई बात नहीं।
Yeah,
We'll,
it's already shared. Probably, some people may not be on that WhatsApp group actually.
okay, no issue, Kaushiki. It's like I will share again this mail with you guys can share with
मैंने
the mail.
दूसरे ग्रुप में भी शेयर कर दिया है
कोई
जिसमें
बात
मेरे को
नहीं।
एक्सेस।
Now टाइम मिलेगा तब आराम से पढ़ना। वेरी इंटरेस्टिंग केसेस फॉर योर नॉलेज ओनली कि what happened with IEL and FS. So what happens now, you guys are doing MBA. Many times if you are sitting for placement or something, what happens many times they give you one topic. So whatever topic in the world you get, if you have little bit even indirect knowledge of that topic, no, you will do well in GD or all these things. So that my main purpose of sharing these articles and all to encourage you to understand what is happening. So okay, you are talking about default, you are talking about credit risk and all, but Joe, uh, you need to just a second, sorry. You need to understand what is happening. So some people may come and ask, okay, you are talking about default and all. Tell me the recent case. So this island FS is a very famous case. We all know something happened, but what exactly happened? This article has covered in little bit in details, in brief actually, and it will tell you the clear picture what happening actually, what happened with island FS. So that's what the main purpose of sharing it, and that's when you do MBA and all. That is a very good thing to learn about. And business standard, economics time, these kind of newspaper, you guys at least have little. I'm not asking to go through with all the news, but headlines and all you keep reading. So at least one or two topic if you find is interesting with you, you will have topics to discuss with people. You will have so many things to discuss and all. And ultimately, knowledge matters. Sometimes we say, okay, communication should be very strong and all. Okay, these things are very complementary and good, but if you have knowledge, nobody can deny that. Okay, if you have knowledge and topics to discuss, that would be great actually. That's how I'm able to talk for 2 hours. No, I'm not saying I have too much knowledge, but based on these newspaper articles and all, I try to bring certain stuff for my class. I'm mostly now I have motivation. I read newspaper. I used to not read newspaper, but since I'm in this profession, what do? I try to read all the headlines in the morning. So I try to think what headlines I can pick up for today's class, and that's how it helps you guys also. You can also have some topics to learn more and all. Okay, so this is the main purpose.
Can I ask one question, sir? I mean,
Yes, yes,
or
okay.
can I just mention something? So see this case study. I mean,
Mhm.
ILFS. Uh,
Yeah.
I mean, after reading this, one gets an impression that you can't trust any company actually, for that matter, because
Mhm.
if something like this is happening in ILFS, I
Mhm.
mean, it can happen in any company, and despite such shareholders, which is LIC, SBI,
Mhm.
HDFC, CBI, I mean, like all these are like large companies, large names,
Mhm.
and even if I look at the directors' names, right?
Mhm.
Okay, those are new board director anyway, but the
Mhm.
existing director names are not mentioned. But you know, how come I mean, like despite such a huge, such a large shareholders were part of it, all these frauds are going on with auditors, with the company, all the directors, create doing all this fraud, and at such a large scale.
So I can give you one answer. Like, to be very honest, it happened with Lemon Brothers also. It was too big to fail, right? You remember, too big to fail. We used to call it. We
But
don't
there
know
was no
what happened.
fraud there, right? There was
Yeah, yeah.
not, I mean, there was fraud. I agree, to an extent, there must have been fraud there as well. But, they were hit more because of the
Uh,
multiple other things. But yeah, continue, sir. I
I'll tell
interrupted
you.
you.
So there was also fraud, Atul. If you read the
Mm,
see, if you are in a position, suppose I'm in a position where you will follow me,
mm,
and I'm giving you misinformation. I'm not telling you the right picture, and I'm telling you, Atul, go ahead with this. You have too much trust in me. You know that Mohit has a knowledge of this, or Mohit, or I got some authority from government of India, or I got some authority from a major bank. Based on my information only, you cannot go directly into my balance sheet. I can write anything in my balance sheet, but there should be some trusted source. Alan Greenspan also did that. He was a big shot that time, and he was trying to. There were people actually. They came and they said, "Sir, it is a big bubble. You are doing wrong. You need to make people aware. This is a risky situation." But these people were earning so much that they did not care. And there's a book called Human Nature, Law of Human Nature. Okay, one day I was reading in that book. There was something mentioned in that book. People do not learn actually from their past mistake. If they have learned, they would have learned from the 1929 financial crisis. They would have learned some oil crisis. They would have learned from the internet bubbles. They would have learned from this Asian economic crisis and all. But people don't learn. In general, we all are human and we actually go ahead with some temptation. Market is doing good, I should also good, and we don't put our brain actually. So one aspect is your human nature, your behavior, or your the human brain and all. We don't actually learn from the mistake at all, and we try to go, we get tempted. I'll tell you, I myself once, like 3 4 years back, I lost some money in the put option and all. Why? Because in the morning I earned some money and I thought, okay, I'm able to predict this chart and all, and I got so tempted, I put some more money and finally I got lost. And then to cover that loss, whole day I was doing trading. Finally I just ended up with like 500 loss, but I was happy. Okay, I covered. But what did I lose? I lose my time. So the human nature do not learn from the mistakes. Second thing, coming to the trust issue, you might have like I think in that article also it is mentioned. Deloitte give very good rating actually. They did not find anything wrong, right? But tell me a single person.
Precisely.
Tell me a single person here we are sitting who do not want to work with Deloitte. Just imagine the brand value of Deloitte, and it's a good company, it's a trusted company and all. So we go ahead with that rating. Okay, Deloitte is saying some Morningstar is giving 5 rating to a particular mutual fund. Definitely we should invest. Same thing sometimes we were discussing about Adani case. Sorry, I might be little bit divert from the topic. I'll come back to this. Same thing it happened with Adani case also, where that particular company mentioned, okay, this company's share are like not doing well. This company's fundamentals are wrong and all shares are overvalued and all something. And Adani lost a lot of money. I'm not favoring Adani, but imagine how much earning power that company had in that time. They could have done some short selling or something. They could have earned a lot. They knew because based on their news, people will react, share price will go down. Okay, so either they could have sold at the time that price was high, or they could have bought the price when it will go down. They knew after 3 4 months market will come back and they can earn. They may have that incentive. I'm not putting any allegation on them. I'm saying anyone can have any incentive or something. So you trust a brand. Suppose tomorrow government is saying or CRISIL is saying this companies had AAA rated bonds. Go ahead and buy this. But who knows the reality? Just can't trust CRISIL. Okay, CRISIL is a known brand. They are providing this rating for long. If they are doing some research analysis, our resources are limited. We don't have that capacity to do research and all. So definitely we will go ahead. We don't know what is the intention of that particular company. So that is actually go with the human law of nature, and that is a company go with your trust issue also. These are the two things, and you are absolutely right. It can happen with any company. It can happen with any bank. It can happen with whatever the major bank is. It can happen with anything. Only thing is that thing is not in your control. That's what we call it uncontrollable factor.
Yeah,
Okay.
precisely. That's what I meant. That I mean, if that means you can't trust any company. I mean, we might have very good corporate governance, examples
Mm-hmm.
of very good corporate governance, but you never know. I mean, this kind of frauds, hand in glove with the auditors, and auditor itself are corrupt. Like, I would say
Yeah.
in this particular case study, Deloitte is a corrupt auditor, right?
Yes.
I
Yes.
mean, and they were banned. I mean, they should have been banned for life. I mean, just because the penalties are not strong, that is the reason these things are happening again and again, right?
Yeah,
So the
because
point
they
here
they
is that
direct.
means that, yeah.
No, no. Carry on. Carry on. Tell me.
No, I was just summarizing the same thing only. Yeah.
Yeah, because they what do they do? It was just ignorant from our side. They will not say we committed fraud and all. They'll say, okay, something wrong with the information. We could not get proper data. The analysis is wrong and all. So many things you have to say to clean your image and all. It happens with anything, can happen with any company and all. So you please watch that movie. I think you might have watched Inside Job. That is mostly on. It's a documentary based movie. It's like about 2008 financial crisis. I will not take name here, but in that movie, you'll know what a major bank and audit firms actually were involved into it. Just see that movie, and then you see, oh my God, these are the banking firms, so these are the financial companies we wish to or we have dreamed to work with. Everyone until today, everyone wants to work with them. They pay well, they're highly reputed. But you see what happened during that financial crisis. Please watch that. Even I'm watching now this again. That I started again that 2 days back only. I watched it time back,
Okay.
so I forgot. So I thought I will have some
It's
input to
on
discuss.
Netflix. Is it on
Yeah, yeah,
Netflix? Okay,
yeah. So I
fine.
thought I will have
I'll
some
do it.
inputs to share with you guys.
Right.
So
The
I
name?
started watching 2 days back.
I'll watch
Inside
it
Job.
today. Yeah.
Yeah, you watch it. You will love this concept, like the way they committed this thing and all, and how it started. They started with the Iceland actually. It's first happened in Iceland. Their economy was 13 billions, but they had loan more than 110 billions. And when they went on default, people literally lost everything they had in their pocket. So you see that movie is very beautifully. The documentary has described everything. I also watched half. Today I'll watch full.
Okay,
So
it's a
just
documentary. It's a documentary
yeah, it's a
movie, huh?
documentary.
Okay,
Even
wonderful.
Raghuram Rajan interviews there. That is very beautiful
Okay,
actually. So you
okay,
please watch that. Okay.
okay, okay.
Okay. So I was able to share. Like I have to share again. Okay, I was to share again. Yeah. Hmm. Okay. This is unit 4, right? Unit 3 is over. Unit 4, we will try to cover as much as possible today. If something left, I'll see how to cover it. Okay, so unit 4 is about your strategies for fixed income investments. But before that, just I want to have you guys a slight revision of your portfolio return thing and all, because I was reading this book which has been shared with you, and someone has covered this portfolio return and this concept also into that chapter. So though it is like slightly not associated with this unit, but it is my duty to at least cover. You guys have already read about, you have already finished your SAPM course. So just in 2 minutes, I will try to tell you how you guys calculate, or we will discuss how have we calculated portfolio return and all in our previous book and all or course, and then we will go ahead with the main content of this unit. So the portfolio return, if you guys remember, huh? So in portfolio return, so I just wrote it also. Let's revise our SAPM. In portfolio return, first you definitely calculate the individual asset return. Okay, you calculate either through return on investment. Sometimes we calculate through CAPM model ends also. So you calculate the return for individual assets, right? When you have return for the individual assets, you try to calculate the portfolio weight. That each individual security might have some weight in the portfolio, and that's how you try to calculate the overall portfolio weight. Okay, in which what do? You divide the investment value of individual securities with the total portfolio value. Okay, this is your second step. In the third step, what do? You multiply the return with the corresponding weight in the portfolio, and then finally you sum the weighted returns, and that's how you have portfolio returns. Okay, we can see these examples also. Suppose you have stock A with initial investment of $5,000. Current value of that investment is 6,000, and you will receive a dividend of $100 also. You have stock B which has initial investment of 3,000. The current value is 2,000, and you will not receive any dividend. Okay, so first just simple way calculate the ROI. Your total investment value right now is 6,000. 5,000 you have already paid for that, like you put an investment, and you will get 100 rupees dividend also. Divide by your 5,000, you will calculate your return, which is 22%. Stock B also return on investment with the same process, you will calculate minus 33%. Okay. Then portfolio weight, definitely your total portfolio, suppose it's 8,000 rupees. You will calculate the weight. First, the stock is the current value is 6,000 divided by total portfolio is 8,000. The weight of that security in the total portfolio is 0.75. Okay, then stock B, you have value 2000 divided by 8000, your weight is 0.25. Value might be here and there, so do not focus, just focus on the process. Then third step is you will calculate weighted return, weight multiplied by the return. Weight multiplied by the return, and once you add those two return, you will have overall return is 8.3%. One is in minus, one is in plus. So your overall return of the portfolio is 8.3%. That's how we actually learned in the SAPM how to calculate portfolio return. Same thing may happen in the case of bond. Okay, till now we did not discuss about bond portfolio example, but in bond portfolio example, since there is a coupon rate, which is your investment, you will get coupon in the form, and if some other additional income you are getting or paying, you have to adjust accordingly. Okay, suppose you have bond A and bond B, one is for 1000, another one is for 2000. The first has 5% annual coupon rate and maturing in second years. The second has 7% annual coupon rate and maturing in 5 years. Individual security we know, but things become complicated in the case of bond. But it is as simple as stock return. Okay, so for bond A, you have 50 rupees per year coupon. For bond B, you have 140 rupees per year your coupon. Okay, if you suppose you are selling it after 1 year, your maturity value is 1000 rupees. Okay, this amount you will receive at the end of 2 years, and bond B not applicable in this case as we are selling after 1 year only. Okay, so whoever will receive this bond, he will receive the 1000 rupees principal. So for bond B, it may not be applicable right now. So scenario one, you will calculate the return for the bond A, and scenario two, you will calculate the return for the bond two. I will share this slide with you. Just read it. It is also as simple. Also, now you have calculated total return after 2 years. You have annualized the return because 50 is per year, and divide 50 is per year into 2 for 2 years. Okay, then 1000 rupees you will get as principal, but at the same time 1000 you paid in the initial investment also, you will have 100 rupees. Then how you will calculate the annualized return? Scenario 2 also same. Once you have the return value, you do one thing, you run the process which you learned in the individual security in the stock market case, and you will get the overall return. That's why I'm just trying to cover it quickly because it was part of that bond, and I did not know why they added this into that unit, but it is not ethical on my side if I'll not cover this. So my only purpose is to cover this so that you can have little bit revision of your portfolio return and all. Okay, so forget about it. Just read these two very carefully when I'll share it with you guys, and you will have understanding how to calculate bond portfolio return and how to this. I'm pretty sure you guys know stock market portfolio return. Just learn about portfolio return of in the case of all the securities are bonds. Okay.
So for
Now
bond B,
yes.
we are not calculating the YTM in this case.
No, it's not.
I mean,
It's just no. We are just right now for the simplicity of this example, we are calculating this coupon payment only because coupon is the actual payment you are getting. YTM right now you can calculate YTM also, but we are actual amount we are receiving in the form of coupon. So we are assuming this is the coupon only income, and that's how we are calculating our return. What is return we are getting in the form of coupon rate only.
okay, only in the coupon rate. But if suppose, I have to also factor in the amount that I will receive on maturity or on selling prematurely, then my portfolio for the bond, I mean, my returns on the bond will be different, right? I mean, that would be
Yeah,
YTM, right?
definitely.
So you will always take coupons only. I mean, you will never consider the principals, repayment.
Principals actually, no, principal is considered. No, if you see in the case of bond A, he will receive principal of 1000. Okay. But to calculate actual return, he has reduced this 1000 also because this 1000 he had paid in the initial investment. He bought that bond for 1000. Okay. He received it for 1000. That is cancelling out each other. You paid 1000, you got your 1000. But your actual return will be in the form of coupon rate only.
Sure. Okay.
Okay. So that's how you calculate the return for the bond also. YTM and all, when you will use at the time of calculating market value and all. Based on that market value, what is your actual return and all. For that, you need to have certain other information also. This is just simplified version only. Okay. Now coming to the main content of this unit. So this unit talks about what are the active investment strategies, what are the passive investment strategies. So just go with the word. Active means, in simple way, the strategies you are actively involved in. You are actively involved with certain methods to beat the market. Okay, you want to what today outperform the benchmark index or the market so that you can get better returns, and you are every day you are involved actively. That's how we do this option trading and all. So what do? You try to get something out of the market, or you want to get better return. If you read the definition also, it says active management strategies are investment approaches where fund managers or individual investors try to outperform a benchmark index by carefully selecting and managing a portfolio assets. Okay, what are the components of comes under active investment strategies? It goes with 3 to 4 factors, in which the first two are very important. Was the first one is fundamental analysis, you might have heard, where we do the analysis of companies fundamentals, economy's fundamentals, or industry fundamentals. Okay, we try to understand our investment, or we try to understand the scenario from a very fundamental perspective. We try to analyze the company in general. Once the company information we have, we want to see what is happening in the industry. Once we know what is happening overall in the industry, then we go ahead with the overall economic factors. I'll share one case also with you guys. Just read that also. Then we have technical analysis. Technical analysis is more like based on current information. Current information in the sense it is not like fundamental analysis where it will analyze the fundamentals like financial reports and all of the company or the industry trend or like overall economic situation. But what is happening right now in the market? What is the trend happening for last 10 years, 15 years? How the market is behaving? Based on those trends, you try to find where you can enter the market, what is the time of like to exit the market, and you try to get out return something like you might have if you are doing rating through zero the trading through zero the and all. They show certain charts where you put certain, okay, after this I want to buy, after this I want to sell and all. So there are multiple charts things and all through which you try to identify the pattern in the market, and based on that pattern you want to enter or you want to exit the market to get some return out of it. Then we have growth investing. In the growth investing, you generally go with the companies having high growth potential. If they are not yet profitable, but you know that this company have potential and that they will do well in the future. So for that also you try to do certain analysis around that company and try to see. Like there are I don't know right now what is the example, but there have been cases where people had better understanding. Okay, right now this company is not doing well, but we know that the fundamentals are very strong and there is a high or very good future ahead of this company. So that comes up with the more analysis and more research. Third thing is value investing. This strategy focus on undervalued stock that trade for less in their intrinsic value. So for that also you need to do certain analysis and you see what is the actual value, and based on your analysis what the value you are getting. If the value you are getting is actually less, then you may say, okay, this stock is overvalued because the value technically should be that much, but the stock is being sold at a higher value. And reverse happen if the value is higher or low. Okay, so this we call value investing. So why these strategies are being called as active strategies? Because you are actively involved and trying to find the ways through which you can actually beat the market or outperform the market and can get better return out of it. Then you have sector rotation, in which you try to move in different sector from one to one. It happened during pandemic also, like people were shifting towards pharma companies and all. In 2018 when government announced very like I think good news about cement industry and all, people were shifting towards infrastructure companies and all. Like for example, suppose today government says we are going to build 20 smart cities in 2024 or 2025. Definitely 20 smart cities, you imagine the amount of cement you need. If the amount of cement you need, you have this analysis in your mind, definitely what will you do? You will go, okay, the cement demand is going to be high. These companies' revenues are going to be high. These companies are going to do well. Why don't I invest in the cement industry right now? But during the pandemic, what happened? Manufacturing company went on halt, and people knew, okay, now demand for dolo, demand for vaccine, demand for other medicines will is going to increase. That's why their revenue was increasing and they were outperforming the market at that time. Then there are strategies called socially responsible investing. This is becoming a trend nowadays. You might have heard this is a hot topic where you want to invest in companies which are socially responsible. Socially responsible in the sense they are considering environment, social, and governance factors. They are taking care of environment. They are not harmful for the environment. They are taking care of social responsibility. They are not violating human rights and all. They are paying very well. This is also becoming a very important factor. They are very inclusive. They are including all types, all categories, male, female, everyone. They are very inclusive. There's no bias against women. There's no bias against other genders. So they are very socially responsible and their governance is also good. There is no like personal benefits and all. They are working in the overall maximization of the shareholders. Okay, so these some nowadays, especially in Europe and all this, people are very aware of it. That's why they are bringing so many. If you see, European Union is actually in the forefront when it comes to adopting ESG strategies and all. They brought CS they brought ESRS, they brought other ESG related tools and frameworks. ILO multinational enterprises law came. Then you had OECD enterprises ESG governance regulations were not regulation like benchmark guidelines were there. So these organizations, what they are trying to do, they are trying to set certain benchmarks the companies should follow because in Europe, this is becoming a reputation for the firms. People are so aware about the environment and social and governing factors that they want to invest in the company which is highly involved into ESG things and all. And you just read any paper nowadays, European Union is actually doing too much into it. Now they brought CBAM. India also has some, I think, class with the CBAM also. So you just read about it. It is very interesting nowadays. It is becoming. I'm pretty sure it is growing in India also, and it should be. Then you have activist investing. Activist investing, what is it is not. I don't know how it is that significant, but actually it involves like when you try to involve in the company's management and try to influence the management according to your wish, like you want to buy a majority shares in that company and then try to bring certain changes like selling assets, purchasing shares or replacing management. I don't know how much it is like good or bad. So this is not very uh like well discussed and all. Okay, so these are kind of strategies which we discuss when we talk about active investment strategies. But as I said, the most important are these two, the fundamental analysis and technical analysis. All things are like as being emerging trend and all are coming up, but these two are the most important and most fundamental concepts when we talk about this active investment strategies. Okay, so that's why let's discuss a little bit about fundamental analysis. So many of you might have like learned about it. This is, as I said, analysis of companies fundamental, analysis of understanding industry trend, analysis of understanding macroeconomic things and all. Okay, so what are the goals of this fundamental analysis? First of all, they try to identify the undervalued investment. This is the core objectives. Okay, so if the company is trading below their true worth, it may allow you to potentially buy low and sell high. That's how they try to identify what are the shares which are undervalued. Okay, the understanding of fundamental analysis, the understanding or doing a better fundamental analysis helps you in taking the more informed decision. Obviously, when you have better understanding of a company, better understanding of industry trend, better understanding of economy, you are going to make very well informed decision. I'm pretty sure many of you like nowadays also people are talking a lot what is happening to Sensex, what is happening to this thing. People are very careful. People know that the growth potential of pharma companies are now high, or now it is AI things and all also coming into trend and all. So you need to have better understanding about every aspect of economy. Then you can take more informed decision. Okay, you can also assess the risk very carefully because now you have all the information around the company, around the economy, and around the industry. These are the key aspects of fundamental analysis we have already discussed. First is macroeconomic analysis, like what is happening, COVID-19 is happening, Okay, Israel, something issue is going on, now election is going on. So what is happening at macroeconomic level, you need to be very careful and how it may affect. So suppose, I think JP case, I remember, I don't know whether how much information I have. So JP constructed this highway that time in UP, Agra Yamuna Expressway, if you guys know about this highway. So I heard they lost lot of investment because of certain things they were guaranteed, but they could not get because of some changes in the political environment and so on. They had to incur a lot of uh, loss because of that. So you don't know what is happening in macroeconomic environment. What is the economic policy uncertainty? The third objective of my thesis itself is about how economic policy uncertainty may affect the bond value in general. So economic policy uncertainty actually try to measures the economic fundamentals of uncertainty around economic activity, fiscal activities, financial activities, and try to measure how it may affect your overall value, overall value of your assets. Then you have industry analysis. As I said, it happens when a trend for particular industry may change. I was giving you example. Suppose there are 8 smart city or 20 smart cities are going to be built in next 1 year. Definitely the demand for the cement, definitely demand for the iron, definitely demand for the other products, what you call lodi, bajri, whatever is going to be high. If the demand is going for high for these products, definitely the cement industry or the industries or the companies which are involved into it will definitely have higher revenue. Then finally, we talk about company analysis. This once we are done with the macroeconomics and industry trend, then we think about at the company level. There we analyze their financial statement, we do the management analysis, we do the competitive advantage, what is happening right now, financial statements, like all this income statement, balance sheet, cash flow statement, fund flow statement, their profitability, solvency, interest coverage ratio, their liquidity, so many things we do. We try to compare, we try to do historical analysis and try to come up with certain numbers or certain insights or certain opinion. Okay, what is going to happen with this form and all. We also do management analysis, what kind of qualified or management they have, how strong it is, what they are going to do. But that comes on another level. Then we see what are the competitive advantage. Do they have a strong brand name? Okay, as was when we were discussing about default and all, I was talking. No, when you will see this movie Inside Job, you will see what the name, what good names were coming into picture. When you will see that, or you'll see, okay, wow, even you will not believe that this much big brand can be involved into all these things. Okay, so then you, but still, as I said, it's always about trust. Deloitte might have ignored that time, but still we trust Deloitte. Okay, it has a long history, the company is well reputed and all, so you still go with the brand. Then you have and you have different valuation technique also. Once you have done this, that you all guys all know, you have P ratio, price to book ratio, a discounted cash flow analysis, and you try to bring the actual value. What is the actual value of your investment, and through which you try to understand whether your share is overvalued or undervalued. But there are certain benefits of the fundamental analysis. For example, it is mostly focused on long-term factors. Okay, because when you do that much research and analysis, definitely it is going to help you in the long term also, because this is a very detailed analysis it involves. If you have obviously better understanding of your long-term factors, or you have better understanding of the company fundamentals, it will definitely reduce your risk because you have now awareness about the company's fundamentals. Okay, or maybe once you have done this much analysis, it may bring out some hidden gems, like you don't know what share is undervalued, or based on the potential you may come up with certain ideas. Okay, this share is undervalued, I need to buy definitely this because definitely it's going to do well in the future. Okay, but there are certain limitations. First of all, market efficiency. Okay, because if suppose all the information is available to everyone and market is in a situation where whatever information comes into the market, the stock price is reflecting that information immediately, your fundamental analysis may not work that much. Okay, but at the same time, there are unforeseen events also. Okay, like economic downturns, change in government regulation, change in government itself, impact of a company's performance, they may have some impact on company's performance, which may make your fundamental analysis prediction little bit less accurate. Okay, then you have subjective analysis also, like how do you interpret the financial data and company prospects and all these things. This can also be a certain barrier. Coming to the technical analysis, and this you might have seen that here I have put a lot of theories because it will actually generally I don't believe putting so much content, but right now why I'm putting because these PPTs and all are mostly into theory and all, and they will help you to learn more about these things and all before your exam comes. Okay, so deliberately I put this that much content into this PPTs, so guys you can read also about it, and if some informations are missing, please do not rely only on the PPT. Just do Google or just go into your book and all and do all these things. So technical analysis, as I said, it is like basically based on the charts, graphs, trend in the market, and then it tries to bring come up with certain ideas or try to get how the market is performing. Okay, Sensex is 70,000 for last 10 days. It is increasing continuously. But then you may realize, okay, based on the historical trend, I can pretty sure that after 20 or 30% increase, the market always go down. So this is the right time to sell because the price will go down. Okay, that depends upon how good you are in understanding those trends and all. You might have learned in this SAPM, like there are different types of charts, candlestick charts, bar charts, line charts. Based on those charts information for last 5 years, 10 years, you do Google, you can find chart anywhere. Based on those charts and all, it's like for example, Google is a listed company, no? So Google or Apple, see, Apple share
It's
price.
listed as Alphabet.
Okay.
Google listed as Alphabet.
Oh, sorry, just wait a second. I hate this Yahoo. Not Yahoo, but I don't know. I do this Google, but Yahoo this comes. I delete it so many times, but ये आता रहता है Yahoo बार बार क्योंकि Google अच्छा देता है कैसे उसका Apple stock price. Okay, okay. See, this gives you trend also. You can see what happened in the last 5 years. You can see, so people generally go with this kind of line charts and all. Okay, here it was this bottom level. From here price started increasing, here it went down, but till here it was increasing. So there might have people who might have understood, okay, after this price will go down, so it was the peak time where they had sold the share and all. So this depends upon your understanding of charts, your training, and how good you are in making investment decision and all. So they try to read these charts and try to outperform the market. You can read 1 year chart, you can read maximum how much they have given maximum, I think for 10, 15 years. See, someone might have bought share from here, but imagine if he had sold it here. So that's how, and see 171 and 198 not, and the time difference is not very large actually between October and December it is. So this depends upon your quality and your research, how well you can read these charts and then can make informed and better decision. Okay, so this is all about charts. Then we have different indicators. We have relative strength indicators. We call it some moving average. Based on moving average, we calculate. We try to see the trading volume and all. Whether the trading volume is increasing day by day, meaning that liquidity is also increasing in the market. What is the momentum of that? How this average is behaving for last 10 days and 15 days. So suppose based on 10 days moving average, you realize that after 10 or 15 days or 20 days, there's a trend that market price on an average is going down. So it's the best time to sell or buy. It is your decision. Okay. So these things you might have covered in your SAPM. That's what I was telling. There would be slightly overlapping with your SAPM course. Then you have support and resistance level, and then you try to identify the chart patterns, which we have discussed so far, how you read these patterns and then try to take your investment decision. But technical analysis also has certain benefits. First of all, you try to identify the trading opportunities based on the trend. You see the market sentiments also right now. Like for example, we were discussing about political stability and all may play a role, and then that's why people take decision around what is going to happen in the country on during election time and all. What is happening right now, how this war may affect my investment. It depends upon the company are interested or invested in those countries. So suppose there are supply chain companies invested or like they are making port and all in the Iran, but suddenly war happens and all the progress may go on halt and the share price may not do well because the revenue is going down and all. So it depends upon the market sentiment. So you read the market sentiments also based on these trends. Then you try to you it will help you in better risk management. This is overlapping with fundamental analysis also. And but there are certain limitation also. First of all, not predictive. That's what I told you. It depends upon how good understanding you have about those charts. These charts cannot actually exactly predict the future. I don't know how people do with that. There's a lot of training and analysis need for that. But still, the past information are never guarantee of future results. Okay. It's again, it's the subjective and it's also depend upon the self-fulfilling prophecy. You might have read this theory. So like if enough traders rely on the same technical signals, their buying or selling activity can influence the price movements, potentially fulfilling the predicted trade. So you may think the price will increase and the price will definitely increase because everyone is buying in that same direction. So that trend may be sometimes misleading and all. So you have to be very careful while you are predicting from the trend. Now, for that, you need to have better understanding of the market and how can you beat those trends and all. For that, you need better research. Okay.
So, sir, I
Coming,
mean, see, from
yes.
a technical analysis perspective,
Mhm.
I think the principle is that it is a human behavior that it captures, and human behavior is not random. It
Yes.
moves in a certain pattern. So
Yes.
if you can recognize a pattern, it will repeat. I mean, it will
Hmm.
always repeat.
Based on this human behavior, that's why there are multiple theories came. Elliott wave theory, I think you might have heard, and Dow Jones something, random walk theory and
Right.
all came. Yeah, this
Right.
depends upon the
Right.
human behavior actually. If you can read
Right.
that pattern and all, uh, there are very quite interesting research is also going on. One of my colleague is doing actually research on this. She will put you in a room and will give you two screen and will try to understand your behavior. She will give you certain money like artificial money or something, notional money, notional amount, and will ask you to invest. So there are certain students who actually got so tempted, they wanted to buy more and more to recover the losses. There were students who actually were very risk averse. They were just settled with the this index itself. So what happens sometimes we trust more this index. Okay, these people are already doing very well research and all, and they are in a much better capacity to learn about human behavior and all. So we just go with that. Some people try to beat the market. So as you said, this is very correct. It's always the human behavior. That's why we have different branch of finance, behavioral finance, right? So that is right. You try to understand behavior through these trends and all, and then you go ahead with the investment and all. Okay. Okay. Now
Yes,
let's
sir.
have we have passive investment strategy. I'll see how much is that. Okay, bond index also we have. So I will share again two more one case with you. Not case, it's a hypothetical example about fundamental analysis and technical analysis. So do one thing, I'll just try to cover more portion and then I will share. You can read it later or try to, we'll see if we have time. Okay.
Sure.
10 or 15 minutes, we will try to cover this passive investment strategies also. So no rush. If something little bit left, I'll just take half an hour class next time and can try to finish. Okay. Coming to the passive investment strategy, as the name suggests, they are more passive and dependent upon the trend in the market or the index already going on. So sometimes we also see a BSC is truly presenting the market picture. Okay, so I can be more relied on BSC Sensex itself because there are people who have done very well research and all, and I just want to go with the flow. I want to just flow with the flow of water and all, and I don't want to do anything. Let the market decide by itself. Let the market force decide the market future by itself, and I will go with this trend. And that's why there are multiple products came into the picture. You might have heard exchange traded fund, index fund, and all. These actually comes under your passive investment strategies. So let's read about it. Passive investment strategies are all about buying and holding a basket of investment that track a particular market index like S&P 500 or a total stock market index. Unlike active investing, which tries to outperform the market by picking individual stock or bonds, passive investing aims to match the market's performance over years, over time. Okay. So as I said, they try to go with the flow of the market. What is happening in the BS, what is happening with the BSC Sensex, what is happening with Nifty 50 index and all. They want to go with the flow of the market. That's why they are passive investment strategy. They themselves are not very active and try to do fundamental analysis or technical analysis. They try to understand the market based on what is exactly happening. So the best advantage of this, it's a low cost. Definitely, it is like you don't have to put your own resources and all. It's definitely it will reduce your cost because there are already certain senses, certain indices and all you can follow and you can come up with your decisions. Okay. So definitely, diversification. What diversification says, passive investment inherently provide the diversification as they hold a basket of securities that represent a specific market segment or entire market. Obviously, this helps spread out risk and reduce the impact of any single security's performance on your portfolio. Definitely, if you have invested into Sensex, Sensex is not just representation of one particular company. It's a presentation of 30 companies. Okay, so your risk is already spread because there are companies are in pharma, which are in manufacturing, which are in FMCGs and all. So your portfolio itself is anyway diversified. Okay. And these passive investors are actually those who want to go for the long term. So they just invest and they let the market decide their future, and they are not actively involved into it because they are mostly risk averse. And the people who are risk averse, they do not want to do their own research and beat the market. They just want to go with the flow of the market and let's just decide. So for example, suppose someone has invested in 1990 in the Sensex. Imagine what would be the value that time. We don't know. I think it must be 1,000 or something. Today's or 10,000 or something. Today's 70,000. If he had not done anything at all, his return, I'm telling you, is much better if he had bought a plot in 1990. Generally, we say no, buy a plot, the plot value goes double. So there is a book by I think Monica. I don't know what is her name. The book is about Let's Talk About Money. In one chapter, she has mentioned that the person who has invested in Sensex in 1980, might be wrong whether this is from that book, but I might have read, I definitely read it somewhere, who might have invested in 1990s in Sensex has earned much better than the person who has invested in a plot or the real estate at the same time. And that person who has invested in Sensex did not do anything. He just invested in Sensex and was taking rest. No maintenance cost, no possession risk, nothing. But you yourself can see, no, it's not about that book also. The index value, what was that time, and the index value is today. Just take the difference between 2010 and 2020-21. The index is rapidly increasing now. The valuation of the companies are increasing rapidly now. So that's advantage of sometimes when you go ahead with the passive investment strategies. And there are research actually that sometimes in the long term, that passive investors may beat the active investors sometime. Okay. What are the common passive investment vehicles or strategies? First, definitely it is index fund, and second is exchange traded funds. So they might be similar, but index funds are like mutual funds. Okay, they track a specific market index, and they are not like you cannot trade them every day, one or 10 times or 15 times in a day. You cannot trade them throughout the day. But the difference with exchange traded funds is that exchange traded funds are similar to index fund, but they actually trade like stock on an exchange and offer investors more flexibility in buying and selling throughout the trading day. So major difference is this only. ETF can be traded throughout the day. Index funds are like mutual funds, buy at the end of value, NAV, and also on net assets value and all. That's how you buy index fund and all. What are the benefits? Benefits you can see, it is lower cost, diversification, simplicity, and long-term performance. Okay, but this is also not free from drawbacks. The major drawbacks are they provides you average market returns, but this is contradictory by their advantage itself. Sometimes they say they in the long term they may beat active investors also, but in the short term they may give you just average market returns only. You have limited control. Definitely, you are relied on someone else's shoulders. You are relied on you are relying on Sensex. You are relying on Nifty 50 and all. So definitely, it may the control is in someone's else hand. And third is who is it is when less, this is less exciting. Okay, Atul has knowledge and he wants to play around with the data. He wants to do certain research in the market. He wants to um, play his own game. So, but if he is like a passive investor, it might be less exciting to him because he wants to do his own research and want to beat the market. He's very good in doing fundamental analysis, technical analysis. Why should he just sit in the on the chair and just wait about the market? Why can't he beat the market? So this is becomes less exciting for him. Who is this investing for? Like passive kind of investing for? It is for new investors, those who don't have much knowledge about the market, or those who like are long-term investors and all risk averse investors, as I discussed in the last slide. Okay, so this is about active and passive investment strategies. Sorry, I might have gone a little bit fast today because I was trying to cover this theory as much as possible. Was it too fast, guys? Like, or was it okay?
It was okay.
It was okay, sir.
Okay, so what will I do? It's just 9:10 already. I have a 20 minutes reading. I'm not like that with that I'm closing this class. You guys take this and read by yourself. And this either I'll share, this is about bond index, how we calculate bond index. And this unit is also over, and with that your almost course is over. If you want to cover it today, I can cover it quickly today this also, and we can finish it, and then you can read those two readings and make your decisions or prepare for your exam. Shall I cover this,
Yes, sir.
or you guys
Yes.
want? Okay, because you no need to sit for next class. You guys, I think 13th you was telling Atul you have this exam and all.
From 13, the internals are starting, 13 to 23rd.
Okay, then let's
And
cover this today
yeah,
quickly, and
yeah.
then we can just finish this today. And I will share two case studies with you. Read by yourself. With this, your fixed income course is over. Okay. If you guys want, okay, this some unit 5 something might have not covered. Any of you let me know. We will see if I can find 1 hour and to try to cover that. Okay. But from my
Okay.
side, this unit, whatever unit was given to me, I have covered today. And this is like final topic in this unit. What is bond index? So bond index is like your stock index. They are mostly similar, but this track the performance of a specific segment of bond. A specific segment in the sense it could be triple A rated bonds index, it could be AA rated bond index, it could be government bond index and all. Okay. So as the stock market index do, same way this also presents the particular bond market segment and is used by investors to measure the performance of their bond portfolio and creating index fund or exchange trade funds that aim to replicate the index performance. Okay, as you see that the stock market index represents the performance of the company listed under that particular index. Same way, bond index also present the particular segment of the bond and try to track the performance in that particular segment. Okay. One of the most widely followed bond indices are Bloomberg Barclay US Aggregate Bond Index, which generally we offered at this AG. This index actually covers the investment grade US dollar denominated fixed rate taxable bond market, including treasuries, government related corporate securities, MBS or asset backed securities. So in India also we have now certain bonds, but the thing is why you will know don't see the bond indices as you see the stock market indices, because they are not actively traded. The trading is not happening as quickly or as frequently as it happens in the case of equity trend. But if you want to see those trend and if you want to see those index, you can go the website of the NSE or BSC. They will give you a fact sheet or PDF format and all, and they will give you month by month or week by week or day by day the end of the day index value or something. Okay, you can just search the website. They will give you this. And there are different segments. They have triple A rated bond segment. They have A rated bond index and all. Okay. So these are also like market capitalization weighted, meaning like the bonds with having higher outstanding amount will have greater impact on the index performance. Okay. It is a rebalanced monthly to reflect change in the bond market, such as new issuance. That's the same thing. Given the change in the maturity, given the change in the giving new issuance, giving the redemption and all, it reflects the change, and at the end of the day and all, they will give you what was the trend throughout the day or throughout the month. Okay. To calculate the bond indices, you need to have certain information, like first of all, the definition. What are you including in your bond indices? Asset-backed securities, mortgage-backed securities, what kind of bonds, like fixed rate bonds or coupon bonds and all you are including. This also you have to see. Then you have to see what is the eligibility criteria. Like sometimes it could be what is the minimum issue size. Just a sec. You want to see the issue criteria, eligibility criteria, like what is the minimum issue size should be there. Then you select the securities, what kind of securities you want to select, what weight you want to give. Then you calculate the index. Oh, sorry, index. Okay. The index value is computed daily based on the total market value of all the bonds in the index. Okay. This I will give you one example, numerical example also in the coming slide. That's how you will learn how to calculate this index. And there's a rebalancing approach, like it could be rebalanced giving the redemption, giving the different new issuance and so on. Okay, given the changing in the ratings, maybe the AAA rated bond now degraded to the A rated bonds, or A rated bonds may might have uploaded to the AAA rated bonds, and that's how you rebalance the index because the valuation may change differently. And then you
It is
calculate the
always monthly. It is always
no,
monthly. I
it could be daily. It could be daily also. I'm not saying.
Okay.
I'm just trying to tell you this in example
Fine,
way.
fine,
It
fine.
could be
I
daily
got
also.
you. Got you.
So take this example. Suppose there are two bonds. Bond A, those four bonds. Bond A, B, C, D. The first bond has this particular value. The bond B has this particular value. The price, their outstanding amount, and based on outstanding amount, you multiply with the price, you will calculate the market value. Same way you calculate for the bond C, same way you calculate for the bond D. Got it? You have price, you have outstanding amount. Price multiplied by outstanding amount will give you the market value of that particular bond. Suppose you have market value for all the four bonds. What did you do? In the first step, you will take the overall total market value of the bond. I think there's some typo in the number. Just for example, consider that the total market value is 498.5 million. Okay. Then second step, as we discussed in the portfolio return case also, you will calculate the weight of each bond in the index by dividing its market value with the total market value. Okay. Now you can get the weight also. The first bond has 20% weightage. Second bond has like 9.52% weightage. Third has 40% weightage. So suppose there's a huge change in the bond C, it may actually shake or make the entire bond index volatile because the stake is very high. It captures almost 40 or 41% of the total market value in that in particular index. Once you have calculated the weightage, you will assume the price of the bond change the next day. Then you would try to calculate how the price is changing from day one to day two. Suppose this is the price which has been given change.
Sir, why
Now
are
you
we multiplying price with another price? Like $101 with $1 billion. Is this 1 billion bonds? It is
no.
units.
I think it's the outstanding amount.
So why are we multiplying the outstanding amount with price?
So how will you calculate the market value? So the market value formula is the outstanding amount of the bond multiplied by the price.
What do you mean by outstanding
Acha,
amount of the
oh,
bond?
sorry, got it. It's the number of bonds actually.
Yeah, this is number of bonds here.
Yeah, numbers of bonds, sorry. So
Okay,
1
okay.
billion, then you have 5 million, and then you have 2 billions. Okay. And that's you how calculate the new total market value. Okay. Once you have this value, your step 4 would be you calculate the index value for the new day by applying the weight change to the new total market value. So the new index value would be like this only. You multiply this with the change. Okay. And that's how you have total index value. Same way, sometimes we try to apply it in the point form, and that's how we calculate the index point. You just read it again and you will know it better. Oh, so fast today. And this is one case I will share with you. Not case again. It is a business standard news article. Please try to read it. What happened when India was included in the JP Morgan bond index. This is a very interesting thing, and India is going to get lot of money sometimes because of this. The index will be international. There would be international investment will be flowing into Indian market and all, and that is a very
Which
interesting
bond
thing.
of India has been included, sir, in this? Which bond of India?
Government bond.
Government bonds. Okay.
Yes, yes. I think 10
Okay.
years government bond securities are included in the JP Morgan bond index. I will
Right.
share this business standard article with you. This
Sure.
and that 5 pages or 4 pages cases about hypothetical example about technical and fundamental analysis. They covers almost 30 minutes reading. Okay. So I'm giving you right now.
Sure.
You can read it and you read it by yourself. That covers actually that's what a part of this unit or this process of teaching you guys. But since we wanted to cover as much as possible today, so that I will give you in the later, like after finishing this lecture. Okay. So that is a 30 minutes reading. Please read it by yourself. With this, from my side, your fixed income security investment course is over. Today for like little bit, we were little bit fast, and those who could not understand, please, I'm open to anyone's discussion or to any discussion and like one-to-one discussion also. You have my mail ID. Just fix a meeting or whatever with me whenever you want. And if you have any doubt and all, please reach out to me whenever you want. Just drop me a mail. Ki we have this doubt on this topic. Can we discuss and all? Just mention the topic and the kind of discussion you want. I will also prepare my material and we'll try to have a better discussion so that I can solve your queries. Okay, is it okay? You all have my mail ID. If you don't have, now I'll just type it here.
So I have one question. Can I ask now?
Yes, yes, yes.
Yeah. So this you talked about exchange traded funds.
Mm-hmm.
And you said, it is like mutual fund only. So what is actually a difference between the two, a mutual fund and, I mean, from the name I understand it's traded on exchange, but I'm trying to fundamentally understand the difference between the two.
Index mutual fund and exchange traded fund, right?
Right, right,
The exchange traded fund are like your stock or the investment. You can trade them on the security throughout the day. The fundamental difference is this: they are traded on the exchange throughout the day. Okay, their value will be changed or valued throughout the day. It is like security. In 1 hour the price is 10, another hours it could be 12 and 13. But what happened in mutual fund? Mutual fund or the index fund actually take the value at the end of the day. Okay, so they will give you the overall net assets value at the end of the day, where you cannot trade them on the stock throughout your day or month. This is the main
yeah.
difference. They are, as I said that
No,
time, no,
but
they are.
whatever amount, see, I mean, where I'm having a doubt and I needed a clarity was that when I buy a mutual fund,
Mhm,
then my fund manager goes and buys on my behalf, right? I mean, suppose
mhm,
I invest 50,000 rupees in an index mutual fund,
mhm,
then as per the index composition, mutual fund manager will go and buy that many index stocks for $50,000, 50,000
mhm,
rupees, right?
mhm,
But in case of ETF, exchange traded fund, if I go and buy a ETF,
mhm.
now, there is no fund manager there, right? I mean, it is just a unit, which is
Yes,
being traded in the exchange.
yes.
So how does it operate then? I mean, like, when will, I mean, is there a fund manager coming into play in ETF?
ETF, definitely there are the people who are offering it. They gives you no, maybe I may not have exact answer right now. Whether they also have like fund manager like we have in mutual fund, because you are right. If they have fund manager like mutual fund have, you yourself cannot trade them throughout the day. Okay.
Right,
So I'll see. I'll look into it and then we'll
right.
come to you. Okay. I'll
And
drop you a mail.
if I am buying, then somebody must be selling it, right? I mean, but in
Yes,
mutual
yes,
fund, when I buy, they give me new units. I mean, it's not that they give me somebody else. I mean, nobody is selling that mutual fund units, right? I mean, when I buy a mutual fund, I get
mm-hmm.
fresh units. But
Mm-hmm.
it's not that there is some trading going on. There's a buyer or there's a seller, right? But in a
Yeah, that's true.
ETF on a trade, there will be a buyer and a seller, right?
Yes, yes.
It it's not the fund manager is not selling there, right?
Yes, definitely, definitely. So I'll read
Okay,
about it more and we'll
sure,
come back to
sure.
you. Okay.
Okay,
I'm
okay,
not sure either I have right now the answer for this.
right.
But I will read about it.
Sure,
Okay.
sure, sir. Sure,
Hmm.
sir. Okay.
So
Okay.
maybe I'll drop you a mail or I'll drop you mail to everyone. You
Fine.
can share it with everyone. I'll try to read
Fine.
about it more.
Fine. Fine. Sir.
Okay. So this thing, thank you, Atul. Thank you for asking this question. And I will definitely see what is the answer for that and we'll try to look into it. Okay.
Sure.
And thank you so much, everyone. And this was a nice, what to say, nice experience with you. It was my like first class, first course, whatever I should say. That's why so there was so much learning from you guys, and I tried my best to give this lecture. If something is wrong or I could not cover, or you wanted some change and all, guys can drop me a mail as a feedback. And if you have any doubt and all, definitely let me know. We can have a separate session. I'm willing to do one by one session also. Whoever has any question and all, please feel free to contact me through mail and all. But this is a very special batch to me because this is my first batch and there was so much learning from you guys. Okay, then I will try to cover this revision also quickly whenever I get time or get the slot, and we will see. So I'm asking you again and again, whatever you guys have, any discussion, query, feedback, comment, criticism, whatever, I'm very open for all these things. So please drop me a mail immediately or whenever you want. Okay.
So your schedule has already come for the revision class.
Yeah, I think it's 18th,
I think
11
so.
to 4. But what I'm saying, I was asking ma'am that can I have this offline because I wanted to have one offline interaction with you guys. So that's discussion is going on with that ma'am, with the ma'am, and I'll see what she says, and then accordingly I decide.
Okay.
Because right now I'm in Chennai, I have my defense on 16th May and that's a pretty big day for me and bit headache is also there because it's a viva
Yeah.
ultimately and there would be a
Yeah. Yeah.
big panel for that. So right now I'm not very focused on revision class, sorry, but I have PPTs and everything ready. Once my viva is over that night itself, I will sit and prepare for your revision class and we'll discuss with ma'am whether I can have it in like a segment 2 hours, 2 hours, or one offline, one online, and then
So
we can conclude.
being a weekday, probably, I mean, offline may not work. People may not come for
Yeah, that's
another
that's
class.
the issue actually. That's what I'm
Right.
asking her if it is on Saturday. If I come back to Delhi like on Saturday, then even I'm willing to come on Saturday the same day. So 16th is my viva. For that, for like 4 5 days, I'll be a bit occupied with all these things. And but definitely I'll try my best if it is possible that if I can give it offline. Okay.
Okay, sir.
Okay, thank you so much. Thank you, Bhavna. Thank you, Atul.
Thank you, sir.
Thank
I'm
you.
literally
Thank you, sir.
impressed with your knowledge. Bhavna, thank you so much for your support and like you're sharing material with all the class. Rupenda, thank you. You're also a good
Thank you,
student. I
sir.
saw when you were discussing about YTM and all. Thank you, Ritu. Thank you, Sonu. Everyone, thank you so much and do well. All the best for your final
Thank you, sir.
exam. And
Thank you, sir.
whatever I have covered in the PPT, please read all these things. They will definitely help you. And I'm pretty sure you will do great in your final exam. Okay.
Thank
Okay.
Yes.
you,
Thank
sir.
you so much, guys.
And good
Thank
luck
you.
for your Viva, sir.
Thank you so much. Thank you. Good night.